All right, gang. Can you hear me and see my screen? I know it's flickering on my end. I don't know if you guys can see my screen clearly. Give me a yes if you can. It's being weird. All right, Charles says yeah. Okay. Maybe it's just me. Computer's struggling. Again, I got a brand new one coming in hopefully tomorrow, but trying to milk the last few days out of this current system. But welcome back to our Monday live Q&A session. Danny, I did get your email. I didn't have a chance to respond to it yet, but I did get it. I just want to not give you a quick response and read through it again instead of rushing through it. I've been on the road for a few days, so I've been trying to catch up on stuff. But welcome once again to our live Q&A session for you guys that are here live, for you guys that are watching on the recording as well. Remember that you can indeed email me questions and I can answer them in this live session. I know I get a good amount of questions from a few of you guys. And I know you can't make it. It's a lot easier for me to explain it in, with charts and video than just email you the answer. But before we get into what you guys have for me today, I do want to talk about one thing. And I was on my way down to North Carolina. I was working on an article, and it was an article relating sports and or professional athletes, I guess, and traders, and kind of making the comparison of how we're essentially the same thing. There's a lot of similarities just in general between professional athletes and traders. Actually, on Wall Street, a lot of the people you see on Wall Street are former D1 athletes and stuff like that. But there's a lot of similarities as far as just the percentage that make it. There's a lot of people that play sports growing up through high school, through university, college, and only a small percentage make it to the big leagues, the professional level. And the same thing with trading. You guys know that there's a very sharp drop-off rate. Only about 90% of, or only about 10% of traders actually make it. And that number is probably a little bit less, but 90% of traders fail in this industry. And one of the things that caught my attention, I want to bring to you guys, I was looking at, is really just the preparation that goes into trading. We all know about top-down analysis, pre-market analysis, having that routine, but really film study is something we often forget, the review process, the journaling process. And I was looking at some of the top quarterbacks, because quarterbacks are basically the coach of their team in a way. Looking at the top quarterbacks and what sets them apart from others, and it's the amount of work they do after the game. And being a former football player myself, I remember that we spent more time practicing, a lot more time watching film actually than practicing, a lot more time practicing than actually playing in the game. And relating that to trading, the actual trading session is probably the smallest, the smallest part of your day. The prep and the review should be the most important part, meaning that after your trading day is done, going back through your charts, reviewing the day, especially if you're a day trader. If you're a swing trader, you don't have to do it as much. But if you're a day trader, after you're done your trading day, you should go back through your charts and see, is there anything I missed? Is there anything I could have done better? Is there anything I did wrong? And just review and kind of grade yourself on how the day went. Just as if a quarterback would go back and watch every snap he took and said, hey, did I make the right read? Did I call the right play? Did I make the right adjustments? And it's very similar to back testing. The way I do it is, I go back through my trading day. Let's say, again, I'm a day trader going on the 5-minute time frame. I go back to my 5-minute time frame. I go back to when I started, and I just click through one bar at a time. I click through one bar at a time and take notes. If I took a specific trade, I make sure I go back to my CTS or back through my evaluation system and say, okay, we did have this, we did have that, we did have that. Okay, that was a good trade. And you'd be surprised at sometimes how you find these little clues, these little things that you missed. I know in the past I used to rush into a lot of trades, go back through my day and realize that, well, what I thought was structure really wasn't structure at all. Or that there was a trade opportunity that I missed that I talked about. I'm like, oh man, I wish I could have took this, but how come the market reversed there? Didn't have this, didn't have that. And then I scroll back through my charts and take a closer look and realize we were at a major structure level. I just didn't take the time to look back far enough. And it's important to take notes on that because again, we want to continuously improve. We want to get better. And in order to get better, we have to do the small things that, well, the other 90% of those traders aren't doing. That's what's going to set us apart. We want to be different than those traders that trade the day and just, close down their charts for the rest of the day. We always want to be doing those little things that are going to put us or give us that slight edge, not only over the market, but over everyone else out there. And, for those of you who are looking to get more aggressive with your trading, we talk a lot about reading candlestick formations and how the wicks of each candle and the closes can leave us clues. Well, how do you think you find those clues? Right? It's just by seeing the same thing over and over again. So when you're reviewing your trade and you're looking at, say, a specific level where the market fell off a cliff and you're saying, man, have you guys ever been there? Have you ever looked at a trade during the day and the market just rallies from it? And you ask yourself, well, why did the market rally there? Why did the market just spike up at that level? Have you ever been there? You can't figure it out. You're like, well, there's no 127 extension there, right? There was no 618. How come the market just exploded from that level? Well, if you want to answer that question, you go back, you scroll through the charts, you look for those clues. You go down to a level which may not have structure, may not have any Fibonacci confluence. You start seeing candles like this. You start seeing doji candle. You start seeing, maybe another real doji candle. You start seeing candles like this where the market spikes all the way down, and then before you know it, boom. And at first, it may not mean much to you. At first, you're like, okay, well, I still don't understand why, but whatever. And then you go through your next chart, you notice a space in time where the same thing happened. And eventually it starts to click. And it's the same way for people that have created systems or strategies. That's how Darren created Cypher. He wasn't actually looking for the Cypher. He was looking for something else. I have no idea what he was looking for. But he was looking for something else and noticed it by accident. I know Charles has done some system development too. A lot of the things you notice is by accident. You're scrolling through looking for something completely else. And you're like, wait a minute, this looks familiar. I've seen this before. And eventually it turns into a strategy. You see this again and again. You start to understand, well, I've noticed that if the market gives me these dojis at an important level, last time we rallied up in a few bars. When we get this doji followed by this pin bar, the market usually explodes up within a few bars. And again, it doesn't mean much at first. You write it down. You're like, oh, could be a coincidence. But when you do this day in and day out over and over again, you start to develop a theory, you start to develop a strategy. And all it is taking repetitions in the market. Again, I was football, baseball, basketball, track. One thing we did during baseball practice is, guess what? We took a lot of swings. We watched a lot of pitches. It was very important that we were able to identify the different type of pitches that the pitcher was throwing. What does a fastball look like coming out of the pitcher's hand? What does a curveball look like? What does a knuckleball look like? What does a slider look like? And at first, you have no idea. They all look the same. I don't know if any of you guys played baseball or not, but they all look the same. But then when you start seeing it over and over again, you look for those subtle differences, and it gives you that little bit of an edge, right? You may not catch the trade, or in the baseball sense, you may not hit the ball, but if you know what's coming, you can prepare for it a little more, and it gives you that much of an advantage. So I recommend you guys doing this fresh when you're done. Don't wait, a few hours, for day traders, don't wait a few hours. If you're a swing trader, you can do a session at the end of the day. If you're a day trader, I would say, right after the live rooms close or right after you're done your day trading time, take 5-10 minutes, off, get some lunch, get some, some coffee, take a walk, get a little bit of time to just get out of the market and adjust yourself, and then come back and just scroll through the last 3 hours bar by bar. It's not that hard. Again, if you're looking at, if you're a London trader, you're trading from 5 to say 5 to 9, it's only this much on the 5-minute chart. It's not that many bars. You know, this you can go through this stuff in maybe 10, 15 minutes, depending on how many pairs you're trading. But just take a scroll through one tick at a time and see what occurred. And if you notice anything, just take notes. Take notes, put in your journal, and then maybe once once a week, or maybe I like doing it at the end of the month, once a week or once a month, review those notes and see what looks similar. Do you have written down 13 times in the month something about a doji candle and price exploding off of it? If so, then take the next step. And again, for a swing trader, you can do the same thing. Again, you're not going to have that many bars during the day, so you may want to do a weekly recap at the end of each week. Just go through the week that was on the 4-hour chart and do the same thing. Do it on a Sunday, Saturday, the day when the market's not open. But that continuous improvement process is very important. So wanted to get that out the way before we get into any of the topics you had. Now, feel free to type in a question, guys. I know we had one earlier about the Gartley pattern and what makes the Gartley pattern invalid for the C leg. And the Gartley pattern, obviously, we start with an impulse leg. The first requirement for that Gartley, we're moving. What do we have out? Some type of news is out. Hold on one second. All right. Gartley pattern, obviously, we have our X to A leg, our swing high to swing low in this case. I always do bearish pattern. I don't know why. I think the brain looks for that. Let me ask you this. Do you guys find it easier to find, when you're doing pattern identification, do you guys find it easier to find bearish setups than bullish setups? Or which one do you find easier to find, bearish or bullish setups? Which ones tend to stick out? If one sticks out more than the other. I got bearish. Never paid. I forgot where I read it, and while I was in my trading pilgrimage, I guess. I remember reading something about it was a lot easier. Something to do with how our brains just operate. I think it has a lot to do with how we read, because we read from left to right, we read from top to bottom. I think I remember them saying that it was a lot easier for the human eye to identify bearish setups than bullish ones. I'm not sure why. I don't know if it's we're used to seeing things top down, so going from here and then rolling down. I don't know. I never knew if that was true or not, so I figured I'd ask. I do remember that. One of the random things that stuck with me from all of those YouTube and Google searches. But anyway, we have our X to A. We know our A to B leg must come back to hit a minimum of our 618. We got to hit the 618. If we touch the 786, it is invalid. And by touch, I mean simply the wick of the candle. So if any part of the candle hits the 786, we are no longer looking at a Gartley pattern completion. We're going to be looking at a butterfly. Now for the C leg, the minimum requirement for the C leg is going to be a 618. So we must, at minimum, hit a 618 retracement to have a valid C leg. Now, this C leg can come all the way down past the 886. This C leg can come all the way down to the A leg and still be valid, as long as we don't go beyond the A leg. So if we were to wick one tick, a single tick past the A leg and still close above, so something like this, then this is going to be an invalid pattern. So again, we can touch the A leg, which is a 100% retracement. You can look at it that way as well. We can touch the A leg, but we cannot wick past it. And the question came up, 'cause I think in a technical trader workshop a few years ago, I think Jason threw in the 886. And again, probably because in a lot of those workshops, even for Syndicate, we try to make it simple as possible. It's very, very easy to confuse people. So we want to give them the basic outline of advanced patterns. We trade them a specific way, but you guys know from reading the internet that these things, there are millions of different rules for Gartleys. Some people, it doesn't have to touch the 618. Some people, all they need is maybe a 382, or it can come close to a 618, or if it passes the 786, it's invalid. You guys have heard all these rules before. And that's fine. If you want to trade them that way, that's 100% fine. Test it, and if you have a positive expectancy, trade it that way. The way we traded though at Trade Empowered is, as long as it does not penetrate the A leg, then it's valid. Then of course we're looking for a 127 extension for our D completion. Again, typical rules you'll see is from the 786 to an ABCD pattern to whatever. We trade it nice and simple. A to B leg, 127 extension of that leg. That's going to be your Gartley pattern completion. And again, the way we do it is we want to make trading as simple as possible. And I used to trade rules where I would look for levels of confluence. So I wouldn't have a specific place where I traded it, but I would say this. I would trade it similar to a 222 Gartley. I knew that there were three things I looked for. The first thing would be a 127 extension from A to B. So swing low to swing high. The first thing I would look for is a 127 extension. The second thing I would look for is an ABCD pattern completion. The third thing I would look for is a 786. And then what I would do is I would take these things and I would look for what had the most confluence and trade it there. Now in this scenario, I drew this on purpose. This is very close to a 222 Gartley. A 222 Gartley is going to be a Gartley pattern where everything lines up. You can see this, guys. 127 right at the 786, right at the ABCD pattern completion, essentially. This is your quote unquote perfect Gartley. However, how many of you guys have traded Gartley patterns before? Give me a yes. Or at least looked for Gartley patterns. Give me a yeah. Yep. Let's be honest. The majority of the time, we don't get this, do we? We don't get the perfect setup, right? Price action doesn't spike right at the 618, does it? No. It often does something like this, right? Price action will often spike maybe somewhere in the middle, right? We get a wick up there. And then our, let me just clean up some of these fibs. Then our retracement would do something like this, right? Our retracement will come maybe all the way down here to the 886, right? So when we're trying to measure out our perfect Gartley, we now have to make some adjustments. Our 786 is going to stay the same because our 786 is taken from our X to our A leg. So that's going to be pretty static. 786 is going to be the same. What has to change now, because we spiked a little bit up, we got to change our 127. Oh, now my 786 is right here at 48.62. Now my 127 is up here at 48.74. And now my ABCD do that over. Now my ABCD happens to be at my 786. And what I used to do in this scenario I would do this. Well, I've got one thing up here. I've got two things right here. I would take the pattern right here. It would adjust per the pattern. So in this scenario, I would take it at the 786. Then we have another time where price action comes right at the 618. And then at ABCD is a little bit higher. And then this time I would say, okay, well, we have the 786, that's all. We've got a 127 a little higher. Maybe I throw in a Fibonacci inversion in there. And I would get an interesting scenario, right? Let's just see if I get a 1414 in there. I would say this, well, I've got an ABCD pattern by itself up here. I've got a 127 extension and a 1414 inversion right here. And I've got a 127 extension and a 786 right here. So I've got two things lining up here. I've got two things lining up here. And actually, watch this. Nope. I'd have three things lining up there. And I have two things lining up here. And I would confuse myself on where do I take it at? So I didn't really have a setup of what I valued more. Did I value the ABCD pattern the most? Did I value the 127? Now we do have an 886 in here, so I can make this 3. Do I value this level the most? And essentially, I was being consistent in a sense, but it was a much longer process than I wanted to go through. It was actually very confusing too, because in this scenario, it's easy. We have 3 things right here. We have 2 things here, 2 things here. Take the one that has 3. But there would often be scenarios, and this is where it started to bother me. I traded this way for a long time, probably for about a year, and I got pretty good results. Before we move on, does this way make sense what I'm talking about? Looking for the confluence for that entry point? Give me a yes if it does. If it doesn't, I'll go back. Okay. Now, I don't want to say this is a bad way to trade. Okay, no. We'll run through this one more time. So let's delete this. Do we have a Gartley on the radar anywhere? Anybody have a Gartley on their radar? Does Eurodollar have a Gartley? Bat patterns. Just try Euro again. All right, let's say, here we go. Let's take Euro Yen as an example. Euro Yen 60-minute chart. So we have our Gartley pattern. And what I want to do is I want to show you how I used to trade it, and kind of just tell you the story of why I made the adjustments. So we have our potential Gartley here, right? We have let me just make sure it looks like it. But all right, perfect. This is a perfect example, maybe. The traditional, well, here's how I used to trade the Gartley pattern. I had the same requirements. X to A, the A to B must come to the 618, cannot touch the 786. Let's draw that on. Boom. Hit the 618, does not touch the 786. Perfect. C leg must come to at least a 618, cannot pass the A leg, so we're perfect on that. So same rules. The difference I had was the completion. Now, right now, you guys know I trade what? 127 extension for my completion. So A leg to B leg, Fibonacci retracement, 127 extension is my Gartley pattern completion. This is where I'm trading at. 130.79s. In the past, it was a little different. In the past, because the first way I learned was the 222 Gartley. And in the perfect Gartley, here's what we have lining up. In the perfect Gartley again, the perfect Gartley will look like this. X to A to B, that A to B is going to come right to the 618. And again, the reason I created the rules for it to begin with, because what? Well, when we're learning the trade and we look through all the examples we see on the internet, it's always perfect, right? No one tells you that when you actually trade, it'll be different. When you first learn, it's always perfect. So my initial rules for the Gartley were like this. X to A to B comes right to the 618. The C to D comes right between the 618 and the 7. And then for our completion, we would get an AB equals CD pattern that completes right at the 786 and also right at the 127 extension, right? Perfect. They all line up the same. That was the perfect Gartley. 127 extension, AB equals CD, and 786 retracement. The perfect Gartley. Now, what I was saying was, hold on one second. You learn this way, you train your eyes this way. However, when you get into the live market, how often do we get this perfect setup? Not a lot. That's kind of the myth of the Gartley pattern. The 222 Gartley doesn't occur all too much. The 222 Gartley is the one that completes perfectly like this. The one that has the 70% win ratio. However, the majority of Gartleys you face in the live markets aren't 222 Gartleys. And that's one of the reasons people, patterns are liars. It's supposed to complete 70% of the time, but every time I trade a Gartley, it's more like 60%. They have this inflated idea of which Gartley should roll over. But anyway, so when I started trading live, I would look for these perfect scenarios, but often I would get a Gartley that forms like this. We get an A to B that forms closer to the 786. So when I try to measure the other two things out, here's what happens. My 786 is going to be right here, obviously. My 127 is going to be right here. Let's see where my ABCD pattern comes in. My ABCD pattern comes in right in the middle. So the question is, how do I trade this Gartley? Do I trade it here? Do I trade it here? Or do I trade it up there? Right? My initial rules were looking for all three things to line up. In this scenario, they're all different. So what do I do? This is where I start to get a little bit confused. And then I would do stuff like this. Well, let's bring in an 886. Let's see where the ratio confluence is at. Nowhere. Let's bring in a 1414 Fibonacci inversion, or just an inversion in general. Okay, well now I have a 127 lining up with my 886, which is close to my ABCD pattern. If I bring in a 1414, I've got a 1414, which is close to my 127, right? So I can probably take the, would you guys agree I can probably take the 786 out of the equation? Going back to what I talked about by looking for the area with the most confluence, right? I can probably take the 786 out of the equation. So now I'm down to these two levels, right? I've got this level right here where I can take the Gartley. Then I've got this level right here where I can take the Gartley. Now at this level, I have three things, right? I have an ABCD pattern down at 3061. I've got a 127 at 3068. I've got a 886 at 3066. This level, I have a 127 at 3079. I've got a 130, I got a 1414 inversion at 3084. So out of these levels, which one do you think is the best level to take this Gartley? What would you guys say? The closer one or the further one? Based on my confluence rules that I have. What do you guys think? Dan says closer to X. Well, I only have two things up there, Danny. I've got three things lower, right? Based on my rules of confluence, right? Vern says the lower one, right? We have three things there instead of two. Raphael still right? Same thing. Don't see anything that indicates one is better. Well, I would say this. Well, if I have three things here, right? 127, 886, and an ABCD pattern here. 3 is more than 2, right? I have a 1414 and a 127 there. I think you know, my rules are trade what has the most confluence, the lower one. Now here's the problem. None of these are right on the dot. Right? I've got an ABCD pattern here at 130.60. I've got a 127 at 130.68. Well, that's 8 pips away. I've got a 127 here at 130.79. I've got a 144 at 130.84. That's 5-6 pips away. And you start getting into the place in your trading where you're saying stuff like, well, this looks closer than that. Well, this is the 86 is close to the ABCD. And do you see how the rules start to get vaguer and vaguer, right? Well, the 1414 is only 5 pips away. Well, this is in the same zone because that ABCD it's you know, the 127 is it's 10 pips away, but it's closer to the ABCD than the 114 is closer to the 127. And your rules start to get vaguer and vaguer and vaguer. And you know me, I hate rules like close enough, right? I don't like rules that says the B leg has to be close to the 618. Carney does that. He gives himself a zone, which I mean, if you have rules for it, I don't think it's a bad thing to do. But for me, if a Gartley pattern comes 2 ticks below a 618, it's not a 618. It's not close enough. Because how do I know it's close enough this time but not close enough next time? I could put in a rule that says what? If it comes within 2 pips, it's close enough. But guess what? 2 pips on a euro dollar 5-minute chart is a lot different than 2 pips on a pound yen 15-minute chart. So do I do a percentage of the way? Do I got to take the ATR into account and then the time frame into account? So do I have this super formula that says what is close enough per each chart, per each individual pair, per each time frame? You could, I suppose. But we're making things a lot harder. And I want trading to be simple. I want trading to be simple. That way I don't overthink myself and get that paralysis by analysis type deal going on. And if you're going to be a day trader, you got to be able to move quick. You may see a Gartley pattern on the 5-minute chart. You don't have time to do all, just whip out the calculator and do 50 calculations or type it into an Excel spreadsheet and enter your NASA-like code. You got to be able to execute the trade quick, right? Speed is key because you may miss it. So we want to make it as simple as possible, and that's when I decided to implement the 127 rule. The ABCD was never into account because the ABCD has too many factors going into it. If we retrace all the way back to A, this ABCD is going to be, it's not even going to close above B. Obviously, I can't take a Gartley pattern that doesn't close above B. It's not a Gartley pattern. The 786 was okay, but it gave me a consistently poor risk reward, similar to the cipher pattern. And the Gartley pattern didn't roll over enough, it didn't have the win percentage enough for me to justify using this small risk reward. So eventually I settled on the 127, which happens to be the same thing Jason teaches as well. So that's my story behind Gartley patterns. I don't know how we got on this topic, but I think it's pretty cool to see the thought process behind it. Now you can go back and implement a rule that looks for the confluence area. I don't think that's a bad idea. Just make sure you're specific as possible. And make sure you test it with anything. Any questions? Any other questions on Gartley's? Hope this wasn't confusing for you. But again, it was something I went through in my journey, and you guys may go through the same thing. Somebody said it was a Gartley on pound dollars. All right. If no questions on Gartley's, any questions about anything else? What else would you guys like to discuss today? Yeah, and that's not going to be. We looked at. I remember looking at this in the live room. It's not going to be a Gartley for me on pound dollar. This would be the leg for me, X to A. You can see we spiked above it right here. Finding the X to A on your pattern. Good question. What were the easiest way to find the X to A is just to look for impulse legs. And you guys should have learned in the first couple weeks of the training just the how price charts moves, how we get starting points to new structure lows, outside return, new structure lows. So going back to that whole lower low, lower close principle. So the first thing you want to do is make sure you can identify a trend. Make sure you know how to measure out a swing high to swing low, a new structure low, higher highs, higher closes, lower low, lower closes. That's the first thing. The confusing part becomes in minimizing the noise. And you're going to get this a lot. We get a lot of traders when they learn it, they nitpick every specific little ebb and flow. See if I can find an example for you. So they would take something like this. They would look at this move right here and say, well, Keel, this is an impulse leg. Well, Keel, this is a leg right here. Well, this is also a leg. Well, this is also a leg. And measure it out like that. And that's fine, especially for practicing. But once you fine tune your eye, what you got to look for is you got to try and measure out the big picture. You got to try and measure out the big picture. What I like to do is this. I like to zoom my chart out all the way. I like to zoom my chart out all the way and look at the big move. What's the thing about, what was it, see the forest and not the trees? It's some type of fancy saying like that. But instead of looking at all the little ebbs and flows in this move like that, right? Can't see the forest through the trees. There you go. I just want to look at this. Swing high to swing low. This would be my impulse leg. Boom. Just one move right here. Ignoring the junk and look for the move. Swing high to swing low. Same thing with right here. Retracement, instead of looking at this to that to this to that to this to that. That's fine on a lower time frame, but looking at the big picture, boom, this is my retracement. Again, eliminate all that junk. And this is my X to A. This is my A to B. Another example is right here. Look at this. We got lots of ebbs and flows inside this. Boom, swing low to swing high. This is what sticks out to me. Even something right here. Swing low to swing high. This is the move. Swing low to swing high. This is the move. And again, it's not, it takes time. It does take time. It takes time, but this is why you need to practice. You need to just go through your charts like that and start training your eyes. It's very difficult at first because again, you're why is this impulse leg and that not? Or why did you take it from there? Why did you use that swing high? Why did you not look at that retracement? And it takes time and experience. But you really do have to take the time, 30 minutes a day, an hour a day, to just scroll through charts and just measuring this stuff out. Saying to yourself, okay, boom, swing high to swing low, outside return, and training your eyes to do it. It's no different. I don't know what sport you guys are best at, but typically at basketball, it's like, you're taught to shoot a certain way. Fingers here, fingertips, this type of spin, elbow goes there, elbow does that. And you're so robotic at the beginning, but the more you do it, the more it becomes comfortable. Your eyes are the same way in the market. The more you do it, the more comfortable you become at it. And I spent a long time ignoring or not looking at the big picture, just looking for the small moves. But as I became more comfortable in the market, I started to be able to filter and know what's a real retracement and what's kind of just junk movement. And it takes time. It comes with experience. But the more time, the more reps you get in the market, the shorter that learning curve is going to be. On NinjaTrader, can you show me how to fix? You can also do this. Matter of fact, now you speak. You can, if you want. Here are some tools that will help. I like doing it manually, but if you go to NinjaTrader, there's two. The swing indicator is good. It's going to be very similar to DSRs. If you have this, even if you're not on NinjaTrader, everything should have the swing indicator. You can put on the swing indicator. You can fiddle with the strength, make it 9. And you see it's going to map out swing highs and swing lows to you. And of course, the more you fiddle with the strength, the lower it is, the more swings it's going to give you. You make it higher, like let's see, 21. It's going to give you less and less. So that can kind of help bring your eyes to structure areas, swing highs and swing lows, and looking at stuff like this. Well, see how it ignored kind of this junk in here? Swing high to swing low right there. Swing low to swing high right there. It ignores a lot of the junk. So swing indicator will help. You can also use something called the zigzag. I'm not too familiar with how to play around with it, but if you change this to percentage maybe and do something, it'll actually draw little zigzags on your chart. Now again, I don't know how to play with the little, I don't know how to really play with this one, but you're better off learning it by yourself. But when you're first starting, if you want to get just kind of an idea of the moves you should be looking at, this is a good way to do it. You see, the more you fiddle with it, it ignores stuff like this, right? This little retracement right here, right? What's the big move? Well, the zigzag did what? Swing low to swing high. This is the big move. See how it ignores this stuff? Swing high to swing low. So those are two good indicators you can use if you're having trouble. Again, eventually you don't want to rely on them, but use them as a training tool to help your eyes. Again, that's the swing indicator is the little dots down here, and the zigzag is the blue lines in the middle of the chart. Training wheel, there you go. Yeah. Hey, it's the same way. DSR levels are the same way. I would be surprised. I wouldn't be surprised if many of you that have the DSR levels don't even use them by this point. Especially you guys that are on your 3rd month in the course. I wouldn't be surprised if you heavily relied on the DSR levels at first, and by now you're like, I don't even need them, Akil. I know what structure is. Has anyone hit that level yet, or not quite? Do you still like them for confirmation? They're really good in the lower time frames. On the higher time, if you're a swing trader, I don't even need DSRs on the daily. I do like having them on for the lower time frames. That way I don't have to zoom back out to my 4-hour chart to see where structure's at. It gives me that zone. But when I do my swing trading, I don't even need them. It should be very simple to tell where structure's at on the swing trade. They're great though. I like them. I like them for. I like them most for to get so I don't have to keep going bouncing out from lower time frame to higher time frame. But once you get used to it, you'll find yourself not even needing them. Danny says on NinjaTrader, can you show me how to fix where my orders don't cancel at the end of the day if I have pending orders? Sure. Go to your. Well, let me get my. Go to this deal right here. Oh, wrong thing. There we go. When you place an order, TIF right here, right? Make sure it says GTC, good till cancel. If you're placing them manually from a chart, and Charles, you may know better than me, I believe all manual orders from a chart are going to be good for the day only. I'm not sure if you can change that anywhere. Again, Charles may know better than me. If you place them, like if you right click and say this is going to be good till the day. Yeah, unless you set up an ATM, which I don't have any ATM set up. Oh, look at that. There you go. You can do stuff like that. I never really got into the ATM strategy. So if I do this, Charles, if I do this, this will automatically be good till canceled all the time when I right click? Or do I need to save it as an actual ATM strategy? Okay, yeah. There you go. That's why you're here, Charles. You're good with computers. Yeah, so 2 ways, Danny, you can either do that. Go to your ATM strategy. And you may have to set it before each day, Charles says, unless you actually save it as a strategy and use it. You can go here. I do a lot of my orders from the control panel. So I go to here and just make sure mine is defaulted to good till canceled right here. And that way they won't cancel at the end of the day. Good old ATM strategies. No problem. Any other questions that I can help you guys with? Heart attack index. This is awesome. I'm on the Main Street Alpha site right now. Look at this. Heart attack index. How likely is trading this going to give you a heart attack? That's pretty awesome. 38% drawdown. That's halfway to heart attack. Oh, look at that. 100% heart attack. Don't trade this. This is pretty sweet. You are 100% likely to have a heart attack. I haven't been on here in a while. Rod looked like he did some good things on here. You ever talk to Rod, Charles? Rod Castelli. Yeah, he's a cool dude, man. Rod is this options trader from California, man. He's like your typical dude from California. He's laid back. He's traded a lot of money, so he's like everything is just like He says stuff so nonchalant. I remember when I first met him, we were talking about Main Street Alpha and his goals for things. He's like, yeah. So like, I said, so what do you what's the big picture for Main Street Alpha? You want to get? He's like, well, really, I want to have a place where we can, I've got some people lined up. I said, Akil, I've got some people lined up. Father-in-law, looking at a couple $1 million to start up, and then put it into. I'm like, wait, you said a couple million? He's like, yeah, a couple, 10, 20 million just to start up for a test run. I'm like, what? And he says it so cool, like he's, I guess he's handled that type of money. And back then, a couple million was, life changing. But he's a cool dude, man. I think he's getting into teaching now. He always wanted to stay. He always wanted to. We tried to get him to do options teaching, but he never wanted to teach because it's very. When you teach, it affects your trading. When you trade, it affects your teaching. And he'd rather make lots of money trading than teaching. So it's pretty cool though. I want to see this heart attack. This heart attack index is awesome. All right. Any other questions before we wrap up today's session? 81% return, but a 58% drawdown. Hey, thanks. Kind of bad with an equity curve. So this one big this is rough right here, going from a high of a little over 30K, 31.5. Yeah, you can't do this. This is, man. This would be a nice. You can't do this. This is why the heart attack index is so high. You can't go from 31.5 to 15. Now this is an impressive comeback, but if you have your hard-earned money at risk, guys, do you want to lose half? No, you never want to lose half. These are some rough swings. These are some rough swings. This is probably a much better one. 6.6% drawdown. Let's look at the curve. Yeah, this is what you want to see. Nice. You get your drawdowns, but nice smooth curve on the way up. This is what you want to see. Only a 6% drawdown. If you for you guys that are going on to manage money, this is what you want to see. Beating the S&P. That's good. All right, yeah. Main Street Alpha. I think I'm going to use this in a. I'm going to use this for an example in our workshop. All right, I will see you guys tomorrow in the live room for some trading. Jason started off the week pretty nice, 51 pips. Back for a positive week. We did take a drawdown last week in the syndicate, but only 1%, so it wasn't too bad at all. And again, keep those. We can keep those losses small. That's all that matters. But until tomorrow, plan your trade your plan, get some training in today, train that RAS, and I'll see you guys tomorrow. Take care.